Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
And we're ready for another exciting program on the MHP Exchange podcast. I'm your host, Frank Rizzo. Joining me as always is my partner, Eric Busadil. How are you doing this?
Doing good today, Frank.
Wow, that's right into it. Eric is strictly business today.
Crickets.
And this is the MHP Exchange podcast, your source for all things MHP related, and it's brought to you by the MHPExchange.com. If you're looking for opportunity, news, education, or entertainment, check out the MHPExchange.com. And on this podcast, we always look to bring to you an insider's viewpoint on investing in the mobile home park space and bring you industry leaders. And today we're joined by Matthew Wolpert from Diamond H Communities. Matt, welcome to the program and thank you for joining us today.
Thank you for having me. Excited to be here.
I'm excited that you're here. And full disclosure, Matt and I were on a panel at a recent IMN conference where we were discussing distressed market opportunities in the MHP space. And it's there I really got an opportunity to talk to him and to hear some of his viewpoints. And I thought he would be a terrific addition to the program. And Matt, Diamond H Communities, tell us a little bit about you guys and your background getting into the space.
Yeah, so Diamond H Communities, we are a growing owner-operator of manufactured housing communities in the Midwest and Southeast. It was founded by my partner, Wesley Hayes, who spent basically his whole career in the MH industry. Myself, my other partner, Kenny Moon, joined a little over a year ago to help us really grow the business. We've acquired 7 properties over the last 12 months in what you know is like a challenging but hopefully rewarding time to be buying real estate. Today we have nearly 800 lots, predominantly in Kansas, which is a state that I'm growing to love. I'm based in New York, but our main office is in Kansas City and our portfolio is predominantly there. We're looking to grow throughout the Southeast. And you know, our thesis, if you go back 18 months when we really joined West to take Diamond H Communities to a different level of growth, was this is the best possible real estate subsector to be investing in. We have long-term secular growth, a need for affordable housing. We're providing America's most affordable housing product in the places where it's needed most. And so we thought the returns were outsized relative to all those fundamental demand drivers. So we decided to go at it. We hope we've been successful so far. We think we have a lot of growth ahead and we're excited about our prospects.
So you and we were talking a little bit offline, and one of the things that, you know, the exciting part is talking about the deals that you're doing, right? So you've done 7 deals in pretty rapid fire fashion. I mean, in the last 18 months, getting 7 deals done is a lot. How is that onboarding and that operation process look for you now?
Yeah. So good news is this is not our first rodeo. So we've done a lot over the last, call it 12 to 18 months, but we've spent our whole careers doing nothing but invest in real estate in a lot of different formats: public, private, corporate, direct, across the cap structure, what have you. Onboarding is a challenge. It's a differentiator between different platforms and owners. It's one thing to make money on the buy and acquire a property cheap. As you guys know, in manufactured housing, this is a very operationally intense business. I think it's a misnomer that you're just buying a bunch of ground leases and you have a bunch of tenants who are going to pay you rent and you don't have to do anything. It's the opposite. It's one of the most operationally intensive real estate sectors you can be in. And it's really important, especially in a period of rapid growth, to invest and build out the platform. So yeah, we've spent the last 3 months reinvesting in our platform, improving our systems, improving our reporting, improving our operations. We weren't doing it bad before, but you know, from our perspective, if we're going to go from 8 properties today to 18 properties at the end of next year. We wanted everything to be fully scalable, and it's really like the trains need to be running on time without a conductor. Like that, they need to run. So if you're stepping in because something's broken or something's not working right, that's an issue. So we're there. I think we're getting everything set up to run where we can really focus on driving value at the communities.
Um, how'd you end up in Kansas City? I'd like to know that. And tell me a little bit about Kansas City. I mean, all of your properties are in Kansas City, right?
They're all 7 of our 8 properties are in the state of Kansas.
State of Kansas.
And
Okay.
1 is in Iowa. Our main office is in Kansas City. 2 reasons. One, my partner Wesley Hayes lives there.
Okay.
And so when we were talking 18 months ago, we thought most important was to start acquiring a portfolio within a driving distance of Wes, given we wanted to make sure that we had our hands on the wheel at the properties all the time. Some of our best acquisitions so far, and what we've seen in our past careers, is hands-off owners. Like this is a space where you can have a lot of owners that aren't present in the state that they're in, aren't present really financially. They outsource it to a third-party manager who in this space oftentimes does not do a great job. And so we wanted to be present at the communities. So that was number 1. Number 2 is Kansas City is a great place to start a business. And Kansas is a great state to invest. So in Kansas City, there's a lot of really high quality, slightly lower cost labor that we can utilize to help build our business. Great airport. If you haven't flown in there, it's like one of the newest airports in the country. Very easy to get in and out from New York or LA or anywhere else across the country. Kansas as a state, very business friendly, landlord friendly, great demographic growth, key interchange for infrastructure. Railroads were built across Kansas. It's one of the key junctions for railroads. Great highway infrastructure to move goods east and west. One of the cheapest costs of power in the country, which, you know, in today's world with data center building, onshoring, that is a huge advantage in Kansas. And last is it's a lower cost of living still. So I think there's a lot of people that maybe would have moved to Texas 20 years ago, and now they're looking at Kansas because you can still buy an affordable home in a $150,000 to $300,000 range and have a great quality of life. So we love it, and we're getting outsized returns despite what we think is slightly lower risk.
Wow, that's great. You mentioned something before where you talked about operational intensity, and I think a lot of people in this space or new entrants in the space kind of overlook the intense work it takes to either turn around or maintain a culture inside of a community and all the different touch points that you might have to have with your resident. So how are you structured to handle that? Right? Because you mentioned about being in driving distance. Are you hands-on in the management of it? Are you layered where you have, you know, a manager overseeing that or a regional manager? Like how hands-on are you and your partners in the day-to-day operations of that community?
We're pretty hands-on. You know, the key thing for us when we started this together as partners was it's really important that we internally property manage. So like that's a key component of it. So there's plenty of firms that are investing in manufactured housing. Not all of them internally property manage. And so if we thought the key to driving value was to manage the properties ourselves. So that's the first piece. The second is we've focused on a cluster strategy where we want to have more than 100 lots in any given market. You won't see us buy properties that are small and tertiary. We want to buy assets and cluster in key markets. So within the state of Kansas, where we now have over 700 lots, we basically have a north of 300 lot cluster closer to Wichita. We then have another north of 300 lot cluster up outside Manhattan, Kansas, in Junction City, which is a market with multiple demand drivers. So we've built the portfolio so that we can operationally be present there by having lots of lots together. My personal opinion is, if you want to invest at scale in manufactured housing, you can't do it by buying one-off smaller properties in secondary markets without scale. It's great for individuals. I mean, like maybe, if they listen to your podcast and learn how to manage a property, like go for it, buy that 30 lot property in, a flyover state. But to really build scale in a company, I think the important thing is to really have a cluster of lots together so you can get a property manager. We have a regional manager in Kansas who's excellent, who's going across all of our properties all the time to make sure that we're driving towards our goals. You guys have the same view or different?
Just wanted to point out something that the topic of operational intensity is really so important for especially new investors, because whenever I speak to someone who is expressing interest in the space, their concept is that, oh, that's great. All you have to do is manage the property and you don't have to worry about the houses. I mean, that's what people think. And it's the exact opposite of that. There's so much more to managing a manufactured housing community than managing an apartment building. So this topic is really important. And we didn't start the way you did in an area where you had somebody on the ground, which leaves me to just, speaking about our first property that we did have, which was 17 hours away. It was a small property in Jacksonville, Alabama. And it wasn't until we got involved on our own and realized that we had to be hands-on, at least in the beginning. The first 6 months, we hired a property manager, a property management company, a local property management company, and we're extremely unhappy in their success in doing anything. We took that on ourselves, and we as soon as we took it on ourselves, we were traveling a lot more to get it where we needed to be, and that's when we realized how operationally intense this space is. And then we started growing out, kind of what like you did from that building. We tried to stay close to that proximity, and we started building inside of Alabama and growing out our team and our infrastructure. And it's very similar to what you guys are doing. We're in 3 states now, but we have clusters in each state of where, we're growing, and we're growing out our team in that area to really oversee those clusters.
You have to, if you're going to look to, the reason why you want that scale is to drive down that cost, because at the end of the day, this is a business of nickels and dimes, right? So to save those nickels and dimes, you have to drive down that cost, and having the scale gives you the ability to do that. So, you're not going to typically find a community that might have 500 pads, but if you could group together 500 pads in a close enough proximity, you could share some of that cost across the board, and that can help drive down your expenses and increase your NOI. And that's what we've seen. And I think the best operators do that. Or to your point earlier, Matt, you're self-managing the property. You're the handyman. You're the guy or the woman on the ground, because it's tough to scale, buying 20 or 30 unit communities in tertiary markets. It's just, it will drive, maybe drive you out of the business, or, drive you to at least lose some hair.
Listen, if you're a new investor and you are interested in getting into this space, you have to ask yourself what size you want to get to, Frank. But I think the best way to understand what goes on inside of this space is to buy a community that is small or smaller, 25, 30 unit community, manage it yourself. That would be the best way for someone to learn. But as far as scaling, 25, 30 unit communities is, it's tough to do it with that.
Yeah, there's one other thing I was just going to say is that scale is not just operational in terms of making money for our investors. Huge benefits from having scale
100%.
and cluster in a market, right? So we have benefits on the financing side, whether it's like local regional banks where we're doing repeat business, or whether we're going to go to Freddie, Fannie, and have enough heft there to do that kind of debt financing. Whether it's buying homes, being able to move homes between communities if we need to bring new homes where the demand is, or the right types of homes, new homes versus used homes, depending on what the lot rents are and the market rents are. So it's operational. It's also massively financial benefits when you can hit that scale. It's hard to do because there aren't lots of great communities out there for sale all the time. I mean, it goes a little bit to the panel that we were on.
Sure.
It's hard to buy. It's not easy to buy.
And I'm curious, what type of properties do you guys look for? Do you look for that major turnaround, or are you guys looking for your, property that's, 75% occupied and you go in, you do a little TLC? What kind of properties do you go after?
So we've done both what I would call heavy value add and light value add. Heavy value add is, we bought a 20% occupied property at a fantastic basis and have been filling it to create value. They're really hard. So you better make a lot of money because they require a lot of time and attention. And in terms of it being an easy or hard asset class to invest in, so many unknowns when you buy a property like that. Unknowns about the infrastructure, unknowns about what the demand is, unknowns about being able to buy or sell homes. That's the value creation, but it's tough. So we've done that. What we love is what I would call the light value add, which you described. So 3-star properties, all age, more than 75 lots, in a market, an MSA with more than 25 to 30,000 people, with a demand driver of either a hospital or an education system or blue collar factory jobs. And then, financially slightly below market lot rents, some vacancy for us to fill up, some operational improvements we can make by buying from a mom and pop or a distracted owner, and then trying to create some value on the debt side too, given our backgrounds. So that's the profile.
So for anybody who's listening, what he just described is basically the absolute perfect property. So, hey, Matt, if you find any of those and you don't want them, just give us a call.
We bought 2 properties at the end of August that I would say fit that, and we're very happy about it.
So walk us through your underwriting, because when you find a park like that, you'll find maybe a mix of tenant-owned and park-owned homes. So walk us through like how you or Diamond H would look at that deal, from how would you equate your park-owned home income into the acquisition price? How would you, what do you look at? What do you equate towards lot rent, or is that not part of the equation? Like, how are you looking to underwrite a deal like that?
Yeah, it's another one where this space versus other real estate sectors, there's so many different metrics. Like if you say cap rate in this space, I don't even know what you're talking about, because
Sure.
Are you talking just the lots? Are you talking with the lots and the park-owned homes? What value are you putting on the park-owned homes if you're just talking the lot cap rate? So there's a lot there. The way that we look at it is, one, is it a market that we want to be in? Obviously. 2, does the property have enough scale to either support its own property manager, or is it in a market where we've been looking at this a lot lately as we grow? Is this a good first buy in a market where we think we can grow? And so we'll buy something a little bit smaller because we think it's the first of many. And then we're looking at, what is our price per lot in total? What is our price per occupied lot? Because a lot of times it costs a lot of money and takes a lot of time to get a property fully full. So per occupied is it's probably a better indicator of value than price per lot. We're looking at our total all-in cap rate, including the rental homes. We're looking at our lot cap rate if you take your purchase price minus the park-owned homes. at what we think is a market value. And then we're trying to be very conservative on our rent growth and expense assumptions to get to what our IRR and multiple would be. So we typically have rent growth slightly higher than our expense growth, but we think one of the keys is to be realistic about how much property taxes and insurance are going up and labor costs are going up. So we're looking at all those things. It's a mosaic. It's like nothing's going to be perfect on day one. We definitely only can acquire properties where we're going to add value. I wish I had a cost of capital to just buy amazing properties all the time, because I think those investors are going to do just fine. But that's not what we have. We have to generate high returns for our investors and ourselves.
So you said something, and I had a conversation with another seller recently, and we're looking at this deal. It's in Alabama, and gentleman buys the park, older homes that are in place from 3 years ago, hasn't made any improvements on the homes. And I'm looking at his numbers, right? And his expense ratio doesn't match up with a park that is predominantly homes from the 80s and 90s. And he's running at like a sub 30% operating expense ratio. So he has a park of park-owned homes from the 80s and the early 90s, and as if there was a prime location there. And he turns to me and he says, well, I'm a value add investor. I raise rents and I cut expenses, right? That was his answer to me. And I was just like, wow, that was genius. You raise rents and cut expenses.
Sounds easy.
Why didn't I think of that, right? So my question, and I heard you say you go in and you look to add value. Like, what do you do to add value? Because I think a lot of what gets said in this is from the operator's standpoint, but what do you do to add value to the community and to the residents that are down on the ground? Like, what is some of the things that Diamond H communities look to do once they take control of a property?
Yeah. By the way, before I answer that, it's funny because most of the time we look at deals, the properties are missing expenses. They don't have extra expenses. It's like there's payrolls of zero. Oh, because the guy's running himself and he lives there. Like, all right, well, we got to pay someone. And they're like, what about these taxes? There's like $5,000 a year. It's like, oh, well, that's just what it is today. I'm like, well, it's going to go up when we buy it. And what about insurance? You're paying like $2,000 a year for insurance? Like, yeah, well, we don't really cover anything. It's like, okay, well, these are completely wrong. So that's mostly what we see when we're underwriting. I would happily love to see something where the expenses are way too high when they give it to us. So it's just funny because I've been looking at a lot of underwriting lately, and most of the time we're missing what we're getting is missing stuff. On value add, I would say there's two things. There's what we're doing now and what we aspire to do. And so when we go into community, there's a few things we're trying to do up front. And a lot of these, like, I got to give credit to my partner, Wes, as knowing what the playbook is to drive value from his time in the space. Number one is we want to improve the look of the community. Typically, there's some really simple stuff. Fixing the roads, which can be a big expense or a small expense, but at least getting started on fixing the roads, which typically we own. Tree trimming. We've been buying in Kansas, Iowa, places where there's a lot of trees. Typically, that's a really big deferred maintenance issue, and it impacts the look of the community. Like when it looks like you live in an overgrown forest, your residents aren't going to be very happy about it. You cut back the tree canopy, you have a clear street. It looks like any other community in America, built homes or manufactured. People are going to like living there. Number three is enforce the rules, which sounds bad, but the majority of residents are very happy about that. So, no above ground pools, no trampolines, no junk in the front yard. You got to mow your lawn. If there's broken skirting or damaged skirting on a house or houses that are really in disrepair, we'll work with a tenant and potentially pay for those repairs, to do them ourselves, to clean it up. All of that benefits the community. And it's just saying that us as a landlord and us as like the caretaker of that property, We want it to be somewhere where people are comfortable living. You just do those first things up front, which doesn't require a tremendous amount of money. You've already spruced up the look and feel of a place. Then there's, longer term CapEx. The property that we bought in August, there was a barn that was used for storage and 5 different mail sheds throughout a 315 lot community. We just repainted them. Nice red color. It's not, a huge expense on our part. It doesn't add any money. There's no return on that investment, but we thought it was the right thing to do to improve the look and feel of the community. Then there's longer term, bigger CapEx. I would say it's what we aspire to do. We're not there yet. We'd love for every community to have a little playground. There's always a lot that you can't fill or is like a weird shape. One of our communities, we're adding just some park benches, some picnic tables, putting down my favorite, a little bit of fake turf to create some green space in that community. So it's those kind of things.
Yeah.
So I just want to back up something that he said that was, we were talking about underwriting the deals with the income and expenses. And you were saying the higher the expenses, the better. When you're looking at these properties, for those of you that are listening, you almost got to create your own income and expenses, right? Because everybody's got a different plan when they're buying the park. Like if you have a plan to do something moving forward, you can't rely on the income and expenses of the prior owner, especially if you're doing, whether it's a soft value add or a deep value add. You have to create what your expenses are going to be. What is that property going to be able to support? And also, if you want to meet certain numbers and make a certain return, you have to really create your own income and expenses.
I think for us, we've always looked at it. It's more important where we're going to be in 24 months than where we're going to be in month 1 or month 2. Because to your point, Eric, when you're acquiring a community that's just maybe multi-generational, or there's a ton of deferred maintenance that's due in the park, maybe rents are so far below market because the last time there was an increase was over a decade ago. Those homes or the conditions in that community probably warrant the number that they're getting. And before you can start increasing income value, you have to make some changes, to Matt's point, right? You have to make some initial improvements. And there's going to be a normal transition. There's going to be some residents that are super happy to see those changes and going to appreciate the fact that you're fixing their skirting, maybe cool sealing the roof or painting the exterior of the home. But there's going to be some residents, a percentage of that resident, that's going to just transition out because they're uncomfortable with change. And we've seen historically in the communities that we've done, we can expect almost like 20% resident turnover within the first 12 months. And so we kind of, now you got to the point where we anticipate before you see an increase, right, we're going to see a decrease. So when we're looking at one of those opportunities that might be value add or a little bit deeper value add, hey, let's make sure that we have the run rate that we're going to burn over the first 6 to 12 months till we can kind of normalize. And then by month 24, where are we going to be at month 24? Are we going to be stabilized? Does this market allow us to be stabilized at that point where we're going to generate the yield on cost that we're anticipating or that we're projecting for our stakeholders, right? Like that for us becomes super important. Where I think in multifamily, you just, when a unit turns, I'm going to do my renovation, I might put in X, and now I could get that to market a lot faster. So I think in this space, you have to understand that dynamic.
100%. The big ones, for anyone who hasn't bought a property before, if I had my learnings from the last 18 months, one is just because it's a tenant-owned home doesn't mean it's going to stay there forever. Like, those aren't permanent assets. They come back to you a lot. And when they come back to you, you typically don't want them. So that's number one, is people way overvalue what having a tenant-owned home means to their returns, I think. Number two is, you got to always over budget CapEx. Like, stuff happens and like people know that, but I think most of the time investors don't reserve enough for unforeseen CapEx. There's so many, This space is amazing because the depreciation benefits for individual investors are awesome.
True.
But there's an element of depreciation that's real, even in MH, and you got to really overestimate how much CapEx you're going to spend over time. I'd say like those are the two big ones that I think. Everything else, like you probably can see if you're new to this and what you're looking at. I think those are the two big learning lessons the last 18 months.
So and you mentioned like taking down trees, right? Just cleaning up the park, but it's also risk mitigation. Like we just we just acquired a property now, and the trees are beautiful, but you don't realize like early on when we were buying a community, we look at the trees and be like, wow, look how serene everything looks. And then you realize what a hazard they could actually be. So we're acquiring a property right now, and just the tree removal and risk mitigation is going to be 90 days, right? And so, and you say, well, it's only maybe proportionally, it's a small amount, but we're going to be investing 6 figures to make sure that there's no limbs over homes, that any tree that might have a root that's going into the underground infrastructure, we're removing so it doesn't become a problem down the road, right? And I think that's something that you have to account for here, because I'm not going up in a bucket truck cutting a tree on top of a home, right? I know I've got to hire somebody who's a professional to do that.
Me neither.
Though Eric might.
I've done it before.
So for you now, and you say, and we've kind of touched on this, like the market this past year. I mean, we didn't find, and I would say we had looked at where rates were going to be reset, and we were in a high interest rate environment from a very, very low interest rate environment. And I thought we never saw a distressed market, right? We have seen distressed opportunities, whether it's maybe a sponsor who got involved in the space over the last few years, and they just realized they don't have any equity in their waterfall anymore, right? Because they misbudgeted or they've mistimed. But what do you see going into 2025 that's going to change maybe the velocity of the transactions we've seen over the last 24 months?
Yeah, I totally agree with you. We really didn't see distress. The only distress we saw were in properties that we would never want to buy, like small tertiary market, poorly run, low quality. High quality properties, there was a little bit of financial distress, like you noted, where somebody was over levered. I've talked about this a lot, but most people that bought a property 3 or 4 years ago have missed. They were right on the top line. Maybe they even did better than they forecasted on the top line, but they probably missed on taxes, insurance, and cost of debt if you had floating rate debt. So that combination is really tough. And I really think it doesn't matter how good of an investor you were. There's a timing element where if you just bought at the wrong time, all of your top line growth got eaten away by expenses and interest expense. So we didn't see a big shakeout. I think 2025, my guess is in MH, we're still not going to see a lot of distress because the fundamentals have just been too strong. There was really no dip in occupancy, or let me say it differently. There was no dip in occupancy and there was no decline in market rents over the last 24 months, even when interest rates spiked. And so we're not going to see really high quality properties, I think, have distress. There'll be a little bit of capital structures that are missized, that need to be right sized. I think we'll see a loosening of transaction activity. Across real estate, transaction activity is near decade lows. There's very little property changing hands. I think most buyers are holding on for better pricing and don't want to transact in the high interest rate environment. If borrowing costs stay where they are, we'll see some good buys. They're not going to be distressed. They're just going to be good in the scheme of things, and a good vintage to deploy capital into real estate broadly, into MH 100%. Again, because the demand is there. There's almost no new net supply. We have a shortage of affordable housing. It's still the most affordable form of housing. There's plenty of capital looking to get into the space institutionally. It's the best possible real estate space to invest in as an individual investor, especially if bonus depreciation comes back, which seems highly likely. So you have capital demand, you have people wanting to live there. It's going to sort itself out. I think there's just going to be more to buy because I think things have loosened up given the lack of activity the last 2 years. That's my guess.
I think that was all well said. I also think you're going to see a lot of, we saw a lot of new entrants over the last few years, right? And in conversations with a lot of these new entrants, you know, when listening to their numbers, I think you're going to see a lot of new entrants leave the space and realize a few things. Number one, they may have bought a little bit too high, right? And also they didn't realize how operationally intense this space is. So I think you're going to see a lot of people that entered the space in the last couple of years leave the space. And I think you're going to continue to see growth, I guess, in companies like ours that kind of gotten past that initial entry point and have their operations in place. And then I think you're also going to see, like you said, you're going to continue to see larger corporations enter the space. I think you're going to continue to see that down the line.
I think, you know, a main differentiator between MH and other subsectors of real estate, there is a constrained supply of communities nationwide. So 44,000 parks, whatever that it's a finite number, and they're not building as much as they are taking away every year. So every year that number decreases a little bit, and it's so difficult to get a new community approved. So here you have this affordable housing crisis that we've had, and straight across the board, every community in the country is dealing with this, and we have the most affordable housing stock that we're not building any more of. So just by nature, it becomes a more valuable resource of supply to have. So it's without a doubt the right spot to be in if you're an investor and if you're looking to participate in affordable housing and you want that to be part of your portfolio. But to Matt's point earlier and to what you were saying, Eric, you need to be with somebody who understands the operational intensity. And Matt, to him and in spending the time to work on operations to stage for growth, I think that's a key element for any operator. We've all had to do that at some point because there's different levels. But that really gears you up for growth. So if you're looking to invest, the operations point of this, you cannot miss or discount. Matt, this was great. I think there was a lot of great nuggets here to go back to and listen to. And hearing about what you're doing and your success in the Kansas market. If anybody has further questions, wants to reach out to you, how would they reach out or find out more about Diamond H Communities?
Yeah, you can go to our website, diamondhcommunities.com, which I think as of today is being relaunched in a much prettier, cleaner format. And hit contact us. You can always reach out to me. Easiest, maybe you can find me on LinkedIn. And send me a message, send me a note. Happy to talk to anybody about anything having to do with MH. You know, and hopefully maybe there's a resident or two out there. Go to our website. We have availabilities. Come live at a Diamond H Communities site, location, property. Our goal, you know, again, like we're at the start of this journey and we want to do everything better. We want to grow. And we're really excited about 2025. So thanks for having me. This was super fun. I really appreciate it.
Well, I appreciate you being on. E, anything that you big takeaway from today's episode?
You know, I think you hit it on the head. You have to take time to really focus on your operations to get to that next level. And, you know, we've been through a transition in software before. At least you know what it is that you need, but you know, it's gonna allow you to really, you know, get where you're going a lot quicker once you're comfortable with the operations that you have. So, and then that was one of the big takeaways that I took from.
And then what you said before, as soon as you get that, there's always that next level of what it takes.
Well, listen, if you're not growing, you're dying, right? So you're always going to be growing. right? So there's never going to be you're never going to stop and say, hey, I don't need to add this or add that. But, I mean, you're at a point where, 800 units, you have a fairly large company. You need to be able to, if you bring in another couple hundred communities, be able to, immediately, implement, your team to do whatever it is you need to do in a timely fashion. So, working on your operations is really going to help with that.
That's a great point. Great to have you on, Matt. Thank you very much and for participating. And I'd love to have you back on at some point to hear about, what you're doing in 2025. If you've liked this episode, drop us a line, right? Send us an email or a comment on that episode, or share it with somebody else who is looking to get into the MHP space. And again, this has been the MHP Exchange podcast. You can check this out at the MHPExchange.com. Until next time, happy investing.